Focus. Ideate. Innovate. Enable.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Your life insurer is saying सबसे पहले life insurance. TV advertisements are saying it. Probably your insurance agent is also saying it. But who will tell you कौन सा life insurance, कब life insurance और कितना life insurance? Today on the Policy Bazaar Insurance Show, we try and get answers for the कौन सा, कब और कितना of your life insurance journey. And to answer those questions, we are joined by people who literally do it for a living. Well, modesty aside, some of the veterans of the life insurance industry. We are joined today by Amit Jhingran, the Managing Director and CEO at SBI Life Insurance, Mr. Tarun Chugh, the Managing Director and CEO at Bajaj Allianz Life Insurance, and Saravir Singh, the Joint Group CEO at PB Fintech. Let's start this discussion, gentlemen. First with you, Saravir. You know, a lot of people tend to think that they have a life insurance policy and they remain happy with it without knowing exactly what kind of life insurance policy do they have. According to you, how important is it to know what kind of life insurance policy do you have, and how important is it to understand that a savings life insurance policy is not the answer for all your life insurance requirements?
Yeah, absolutely, Yash. It's a wonderful question to start the show with. I think consumers must very clearly understand what kind of life insurance they have, because the first risk that we have to guard against is the risk of living too little. And if we are not there, then who will help our family, our children, our wife, etc. So the first thing you must do is to ensure that you have a term insurance policy which pays off in case you're not around, and make sure that your family can live a proper life. Now, to calculate the right amount of term insurance that you need, one is to look at your income, and a useful rule of thumb is to look at it as 10 times your income. Secondly, you should calculate what are your liabilities, like a home loan or something. So when you add these two up, then you get the amount of term insurance that you need. And I would again urge everyone that life insurance in India is very economical, it's available very widely, and I think everyone should start with a term insurance policy. Savings insurance policies have their own role to play, and those are, I would say, step 2 and beyond.
Correct. You said सबसे पहले life insurance and सबसे पहले term life insurance. So let's first start talking about term life insurance, also the insurance for the risk of dying early. Term life insurance is a guaranteed claim benefit paid to the insured's family after his or her death. You would ask, how is it difficult from a savings policy which also pays claim benefit after the death? Well, if one survives the policy period in term life insurance, then there is no claim benefit which he or she receives. Mr. Jhingran, to come to you, and I'm going to step into the policyholder's shoes to ask you this very question. Why should I buy term life insurance when a savings policy or a ULIP policy will pay me even if I survive the policy period? Why should I pay money as premium towards a policy which, if I survive the policy term, does not pay me anything?
Think of a cricket match when a batsman walks into the field. He knows he is going to face either one or maximum 2 bouncers during the inning, but he always carries his helmet because of the protection that it provides, and that protection gives him the confidence to face all the balls and hit them to the boundary. Now, the same context applies to the term insurance. Today's context, the young generation that is India is having, the demographic dividend that we talk about, a large young generation, and the expenses habit, the expenditure habit of this young generation is changing. The household savings are going down and the household debt is increasing. So in these circumstances, the aspirational buying of the young generation, that is creating a lot of liability also on them. They need to ensure that after them, their family enjoys the same kind of luxurious lifestyle, the convenience, and they continue in the same way. So for that, it is very important that they get a term insurance with adequate cover, which Mr. Saravir Singh very aptly described as 10 times of the income plus liabilities and all.
Tarun, to come to you, just to continue the point on term life insurance, according to you, is there a particular time in your life as you grow to get a term insurance policy? And what should one look at? Should it be to get a larger cover straight away as you buy the policy, or keep gradually increasing that cover? How would you ask people to look at term insurance?
Yes, the best way of looking at term life is that whenever you have some responsibilities and you started earning, that's the best time to buy a term life, because there are some dependencies, their family is dependent or somebody is dependent on you. Hence, your being there is very critical.
Correct.
So, you take a term life policy. Now, how much, how big, and how often? These are questions that we frequently get, and I think it's a very apt question that you ask. My colleagues have already talked about the 10x, 10 times. So, we came up with a campaign which said 10 times your annual income is the amount you should normally get your cover for. Now, when should you start? Should you start with a very large cover when you are young, or should you add as you go? So, the sooner you buy life insurance, the cheaper it is. See, there is a value for money bit that comes in. So, for example, if you are a 30-year-old buying a crore cover on a regular paying policy, what you will do is you will pay around approximately 10,000 rupees per annum. If you are a 50 years old who's going to buy that policy, you will pay 3.5 times that. So, it is the sooner you start with some responsibility, that's the time you should buy. So, best is to maybe wait for a period of 5 years and then reconsider. Usually, it is better to look at some life event. Suppose you had a child. Suppose you got married and you had a child. Suppose you had a second child. Suppose you got a very significant promotion. All these times you should add to further covers. But I think ballpark thumb rule, every 5 years you should reconsider the amount of cover.
To you, Saravir, and these are two very natural questions from the point of view of a policyholder. If, let's say, my term life insurance policy comes to an end, is there any way that I can sort of extend that policy if I want to continue with the same policy? And second question is that if somebody is sort of the view that he needs something, even if he lives the policy time span, is there any variation of term life insurance product itself where he gets the cost benefit also, but he also gets something if he survives the policy period? Both those questions, both those kind of policy holders, what is in store for them?
I think there are policies where if you would like, you can choose, you can elect to extend the term after a certain period. So, I think when you buy a policy, it's very important to understand what are the terms of the policy and whether or not this feature is available. There are also policies, to what Tarun just spoke about, the fact that as you enter different life stages, you can actually increase the cover. So, your medical etc. has been done once, then you can, with a declaration, you can increase the cover as these life events happen. So, I think policies come with a lot of flexibility today in the market, and both these type of things, the one that you mentioned, to extend the term insurance and as well as to buy at life stage. Now, in terms of the second, again it's a very relevant question, because a lot of times people feel that mujhe kuch milega nahi. So, there are two variants now over here. One is a return of premium policy, which is called TROP in the industry, where you pay a slightly higher premium every month, but at the end of the policy term, should nothing happen to you, then you get all your premiums back. So, there is a very clear choice that you have available there. Second, a very interesting kind of term insurance policy that exists these days, where you can buy, let's say you are 30 years old, you buy for the next 40 years or 45 years, right? Now, let's say you turn 60 or 55, and at that point you feel that right now your responsibilities are not there, your children are doing very well, etc. You don't need that cover. So, you can actually return, or you can give up that policy, and you get all the premiums that you have paid minus the GST back. There are various, I would say, the various insurance companies have come up with wonderful products which are of different kinds, all suited to match the needs of customers. So, again I would say go out and buy a policy, there is no excuse to not having one.
But as we move forward in our discussion, let's upgrade our life insurance journey. Let's speak a little about credit life. Credit life insurance is typically a type of life insurance policy that helps repay a loan amount if you die before the loan amount is repaid fully. On to this topic, Tarun, how does it work? Because this is one side of life insurance which is not known to a lot of people, and they don't understand this thing, but plays a very important role, which is only understood if you are in that situation. How does a credit life insurance policy work if there is a loan amount that an individual has? As he keeps repaying, let's say, that loan amount, does the premium for this kind of policy also keeps coming down? How does the mechanism work, if you could tell our viewers?
Yeah. So whenever there is a credit that you take, so it could be a education loan you take or a personal loan you take, home loan, any kind of loan that you take, there is a liability that is coming on you. So आपको वो वापस करना है.
Correct.
And if something happens to you and you're not able to pay, then your family is actually in a minus. They'll have to, survive without that asset, because you'll have to return the asset or you'll have to pay the loan back. Hence, what life insurance companies have done, it's a very classical kind of insurance policy. It's a single premium policy, which is taken over through a bank who is basically taking a master policy for all its loan holders, and it converts that policy into an easy EMI. So it wraps it around your loan. So if your loan was, let's say, X, then it will become X plus little bit.
Saravir, I want to come to you with a little tricky question, but as I evaluate the first part of discussion, that was on term life insurance and credit life, one question that comes to my mind is that if I buy a term life insurance policy, if something were to happen to me, the life insurance company gives me some amount of money. Now, the family can use it to pay if there were to be any debt on me, right? Credit life insurance policy, if I buy, the same thing happens, but in a different way. The life insurance company pays to the creditor. Do these policies have to coexist, because eventually they solve the same purpose? Somewhere they sort of intersect. Do they have to coexist? Both are needed, and if yes, then why? Or does one of the two policies serve the purpose of having, taking care of the people who you leave behind?
So, I think, Yash, a properly sized term insurance policy should take into account both the income that needs to be replaced, like we said, 10 times your income, plus any liabilities that you have. So, my suggestion actually would be always to have a proper term insurance cover which takes into account both these things, for two reasons. One is that it's a more holistic answer, right? Because when something happens to you, paying off the loan is not the only consideration for the family, right? There's a lot other things that have to be taken care of. And secondly, what we find in the market is that actually credit life policies tend to be priced a little higher than standard term policy.
Correct.
So even from an economical perspective, you're better off having a proper term insurance policy which covers both your income and your liabilities, and hence it subsumes the credit life component as well. Now, having said that, it's not always possible to match everything to everything. So, if you don't have a fully fledged I would say term insurance policy, then please don't forsake the benefit of a credit life policy.
On that note, let's take a very, very short break. On the other side, we discuss annuities, the life insurance for the risk of living longer.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. Let's speak about annuity plans now. So, we've sort of started from the risk of dying early, graduated a little into the life insurance journey to take care of the liabilities that one would have in their lives, and now we reach the third year where we speak about the risk of living longer. Now, an annuity plan is a person pays either a lump sum amount or regular installments in a given period to get regular payments or payouts as long as he or she lives, or for a pre-specified period. Now, to speak a little more on this thing, first we'll start this discussion with Tarun. Tarun, I want to understand now, this is a little more complicated in terms of who's paying, how much one person has to pay, what is the return that he is supposed to get, and at what point will he start getting the returns. Those four questions, if you could answer to us, who pays, for what does he pay, when does he get the return, and how much return can he expect or ideally he should plan for in an annuity life insurance plan?
One is an immediate annuity, the other is a deferred annuity. That decides for how long do you pay and when do you start paying. So, immediate annuity usually is a simple product which says that I put a lump of money with the insurer and immediately the pension starts. Okay. So, I will give you an example. If you want a pension of, let us say 50,000 rupees a month, then at the age of 60, you will have to pay about 90 lakhs in one lump sum. So, that is the original plain vanilla annuity that is there. Now, if you are willing to pay a little earlier, which is usually in insurance the best way of working, then you can buy what is called a deferred annuity plan, and then you can start paying at the age of 40. And 40 is the earliest usually, and you can have certainty of getting a return for as long as you are alive. And Yash, what is happening is that people do not realize, and this is the most undersold, understood risk of living longer, that today you may be earning for, let us say 25, 30 years,
Correct.
but when you retire, you may be alive for 30 years. The average Indian living till 60 nowadays live till about 82, 84 years. And in the cities, the diaspora has better health facilities available, and you can live till 90. So, you are not going to get any salary for those periods. So, hence it is a very important risk to cover. And at 40, if you were to buy it, then just 17,000 rupees per month till the age of 60.
Correct.
And then you get a pension for as long as you are alive. And you asked what is the return? Ballpark, I will say it is a GSEC rate, जो भी government securities के rate होते हैं.
Correct.
So, around 7ish is what the kind of return you can get, 7%. And getting a fixed return and not letting the risk of reinvestment, hit you
Correct.
for 50, 60, 70 years till you are alive. Now, my actuary is always worried that, the person who is going to be alive till 100 and beyond is already born. So, what happens then? So that risk is not covered, and particularly in India where we do not have social security, it becomes a very important risk to cover.
Okay. But Tarun, as you explained the process, and of course, you spoke about how it works, is there some sort of thumb rule here as well to guide people who are looking at a product like this on three aspects? A, what is the ideal time to start? What is the ideal money to put? And what is the ideal return that one can expect after, let us say, retirement?
So, ideal time to invest usually is 20 years before your planned retirement.
Okay.
So, if you are, so normal ages क्या रहती हैं, 58 or 60, so minus 20. So, that is when you should start investing.
Okay.
And ballpark you can expect the math gets to be a little complicated. It's an XIRR. So, it's broadly the GSEC rate and whereabouts is what you can expect to get.
But Mr. Jigran, if I had to extend the same question to you, and now we are at a time when people understand taxation very well. What is going into the income before getting added into the income? What is the taxation that it can attract before, as you sort of receive it itself? When you speak about annuity products, after a particular age, they start paying you, right? Now, the payment that you receive or the returns that you receive out of an annuity product, it is very important for a person to know the kind of taxation that also it would get. Help us understand what is the kind of taxation that this particular income sort of attracts. Is there just income tax that one has to think about in his income, or since this is capital gains also, does it also attract some sort of capital gains tax?
So, yes, you talked about that term insurance first, and now for the post-retirement years, the annuity product.
Correct.
In India, where social security is one issue, this post-retirement income is very, very important, and everybody should plan to have a proper income as per their lifestyle needs for their post-retirement and take a particular annuity policy. As far as taxation is concerned, this income of annuity post-retirement, it is added to your regular income, and it is taxed as per the applicable slab that you are falling in. So, and there is no capital gains, of course, on this product. So, you should plan this income as per your regular income and pay tax as per your regular tax slab.
Saraveer, as we conclude this discussion, one final word to you, and again from a policyholder point of view, if I have the capability to pay, let us say, a higher amount today, I can afford to pay a higher amount because I want certain amount of lifestyle after I retire, and I want this money to sort of support that lifestyle. Is there any cap or limit that on how much can I contribute towards an annuity product? Second thing, in terms of the money that I get, whenever I get it, is there a particular way that I can only receive money annually, or can I also choose the way in which I receive the money from the life insurance company? Could it be quarterly? Could it be monthly? Could it be half yearly? Because of course, you will plan your financials depending on how the source of income comes in.
So Yash, I think to answer your first question, this is a wonderful product from a ease of issuance perspective. You can invest almost any amount of money. There are no medical requirements, etc., because you are investing, for a period of time. So there is no issue in terms of how much you want to invest, and even the process of investing is very, very straightforward. In terms of getting the income, and I would use the word, it's like a salary for life. See, an annuity is essentially a salary for life, and that salary you will get. You can take it monthly, you can take it quarterly. In some cases, you even have the option that if supposing some life event were to occur, some critical illness or something, you can even get some part of the principal back earlier. So there are a variety of products that are available. You can also buy it in a joint life format. So let's say for you and your spouse, so the policy will continue for both your lifetimes. So both of you are taken care of, whichever person survives longer, etc. So the product is very flexible, very easy to buy, and then even the payout can be structured as per your requirements and in a very, very flexible manner.
So of course, the product, all three products, in fact, for that matter, that we spoke about, are very flexible. They take care of the different requirements that you have, and with that, it seems like you have to some extent graduated in this course of life insurance. That was the ABC of life insurance breaking down for you by our industry experts. And now, when somebody tells you "Sabse pehle life insurance," you would know and you should know what kind of life insurance comes at what time, and which one do you need the most at what point of your life. But with that, it's a wrap on this special programming. We will come back with another very, very interesting episode, and thank you, gentlemen, for giving us the wisdom that one requires to choose the right amount of life insurance. Thank you so much. With that, it's a wrap on this edition. Stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Presented by Policy Bazaar.
Focus, ideate, innovate, enable.